The Fed hikes rates 50 bips and markets squeeze higher, only to get sold and make new lows. Long-term bonds collapse ahead of Treasury auctions and CPI data this week. The dollar remains firm and commodities roll over on demand concerns. All this and more in this week's Macro Insight. What happened last week? So obviously last week was all about the FOMC. And, you know, we had a bit of a roller coaster ride. FOMC delivered highly anticipated 50 basis point hike. That was kind of a done deal. But everyone wanted to know about, you know, pace of QT, whether that would get confirmed and what were they saying about future hikes. And Powell basically took the 75 basis point hike that had been priced in, probably about 85, 90% priced in for June. He took that off the table and said they weren't even considering a triple hike. So, you know, market initially took that as a dovish surprise. That triggered a vicious short covering rally. VIX dropped by about 5 points. S&P squeezed about 150 points from 4150 to 4300 in short order. Now, the rally was pretty short-lived, obviously. We saw renewed selling, likely from the likes of, you know, funds that have bond and equity exposure, and with that correlation going higher and higher, those risk parity types, if you want to call them, you know, started liquidating and lightening up on positions. And it seemed to be quite a program selling type day, taking the market straight back and giving back all those gains within 24 hours, and then taking out those lows and making new lows, basically, right? So non-farms didn't really help. Got that on Friday. Slightly better on the headline, but slightly worse on the participation rate. Didn't really change the market's perception of the Fed flight path. So didn't really offer much support to the market. And then sort of on the week, you know, stocks ended down, obviously, in the US, but not massively. Europe and Asia were worst hit. So, you know, seeing, let me bring up this graphic. You know, you can see here in terms of the major movers, equities kind of in the orange getting hit. So you had DAX, Europe, Asia, FTSE all down sort of 1.5 standard deviations. On the, you know, other things getting hit were currencies. So cable, particularly badly hit, about 2 standard deviations, along with CNH as well, as China continues to let that thing devalue. On the upside, you know, yields again leading the charge. In terms of outright US, it was more curve steepening that we saw in the US, with 7s, 10s, and 30s up, but 2s and 5s down, obviously after Powell kind of giving that slightly dovish rhetoric out of the meeting. But the thing really concerning markets was, you know, the credibility of the Fed. You know, what do they want to get ahead of the curve or not? Because if they do, then why are they not going at a faster pace to kind of get above neutral rates? Basically, that was kind of the argument there, and the excuse maybe for why we started to see some more aggressive curve steepening. We have also got Treasury auctions this week, right? So people may be pricing a bit of a move in yields ahead of that. Other than that, Scandi rates kind of quite a bit higher as well. So you see Sweden there, Norway, but that's basically it, right? So we've seen this theme, you know, for months now, where the blue bars tend to be in the rates world, and then, you know, we're seeing general equity weakness, basically. And then commodities, you know, a bit of a mixed bag, nothing too stand out there, but obviously crypto there starting to finally move. These moves don't actually encompass yesterday's shenanigans, right? But obviously crypto finally having a bit of a move. So those are the major sort of moves that we're seeing across asset classes. Now, if we look at kind of, you know, what's the market looking at? What are the main sort of stories at the moment? The big one really is, you know, have we got peak inflation yet? This week, we're going to get US inflation data for April, and market's going to be kind of, you know, reading the tea leaves and trying to understand whether or not we've actually seen peak inflation. Now, Raoul Pal, for those of you who kind of watched his latest recession watch type campaign, he put out loads of charts, obviously, that he does for macro insiders. I just picked one that kind of stood out to me. You know, he's looking at things like ISM inventories versus new orders versus inventories as a lead indicator to ISM. So it's a metric that I've mentioned to you guys before, suggesting that we are going to get a bit of a rollover in growth. And, you know, looking at that and kind of superimposing that upon the US CPI, the idea being that, you know, you've got quite a big disconnect here between what we're seeing in CPI and what we think forward-looking growth indicators are going to do, and saying that that rollover in growth, you know, if ISM goes into, you know, 50 or below type territory, that's going to kind of take growth down, and then you're going to see inflation rollover, right? So that's the argument. We saw, you know, similar sort of disconnects happening in 2008, 2009, and obviously, you know what happened, right? So he's kind of calling for that type of move. Whilst it's, you know, likely that inflation is peaking, the big question, and this is what Jim Bianco talks about a lot, is, you know, how quickly will prices come back down? Even if we have peaked, in 3 months' time, if we've still got inflation on a 7 handle, that's not really going to help much, basically, right? The Fed's not going to be able to slow down if that's the case, right? So really, it's going to be a function of how quick things move down. And because a lot of this inflation seems to have been driven by supply chain issues, I think that's going to be a major factor, right? So if supply chains don't heal as quickly as we want because of issues like Russia, because of issues like China lockdowns, then maybe even if we see a peak in inflation, maybe it's not rolling over quickly enough, and then, you know, we've still got this issue where the Fed is kind of forced to continue to hike aggressively. Now, obviously, like I said, bond markets have been having big moves. We saw more steepening last week. You know, it did start to feel to me a bit overdone. We reached a pretty major level in TLTs in the 30-year. So I kind of dipped my toes in. The way I did that was via some call spreads, as you guys will know, in the trade alerts put out yesterday. So I wasn't really quite ready to buy outright delta, even though I've got some in my long-term pension portfolio. I didn't add to it yet, but the way I saw it, you know, I started to see a scenario where equities were on a bit of a cliff edge. And if equities broke 4,000 on the S&P and we got a bit of a vacuum down to, say, anywhere between 36 and 3,800, I didn't think that the bond market would sell off on that, basically, right? Up until now, we've had bond market weakness leading equity weakness. But now if we start to get equity weakness leading as people liquidate and, you know, as retail kind of have stopped buying now and real money's offloading and we're seeing quite a lot of outflows, if that starts to kind of snowball, I think the bond market actually finds some support on the back of that, basically, right? And that's kind of the bet I'm making. And it's a pretty short-term bet. I just think we're in this sort of pocket of time over the next month or two. If we get that equity market crack, then I think bonds will have a decent move, right, to the upside, right? And then I'd look to monetize that. So the expression I've used is a July call spread, 120, 130. Vol's pretty elevated. And I didn't really want to pay up for the vol, basically, right? And July gives me plenty of time for that view. Even if I'm early and bonds have got some more downside, then when we do get that knee-jerk rally in bonds, maybe I'll still be able to make some money off it. That's why I went to July. You can see here, you're also seeing some technical RSI bullish divergences in the 10-year. So that's here with this momentum indicators kind of making higher lows whilst the bond is making lower lows. And then you've also got speculative shorts that have grown quite a bit within the treasury market, according to JP Morgan research there, right? So you've got a few things lining up for the idea that maybe there's a bit of a short squeeze coming in bonds, particularly if equities are on the edge, basically, right? And it kind of feels like they might be, yeah? So that was the logic there. If we kind of have a look at equities still, you know, as I mentioned, retail are pretty underwater, right? So we've said for a while that retail seemed to be the marginal buyer based on, you know, various data that people have been throwing around. Now, ARK being the sort of poster child of retail, this is ARK's performance superimposed on, you know, the NASDAQ of the dot-com bubble. And it's been tracking it pretty amazingly. This is something Julian Brigden's been talking about as well, right? And yeah, pretty impressive, like that kind of popping of the bubble. If you see how that ARK move is tracking what the NASDAQ did, it's very close, suggesting that there may still be further downside, but we may also be in for a bit of a short squeeze at some point. And those short squeezes can be seriously violent in the order of magnitude of 50%. All right, so don't be surprised. ARK, I think, hit around $40 now, that ETF. Don't be surprised to see 60, right, which is a 50% rally before we then go down again and maybe ultimate resolution somewhere in the 20s or 30s. Basically, that's the kind of price action that these guys are thinking about. This data out from Morgan Stanley Quant is kind of trying to measure the estimated P&L of all the retail flows since the start of 2020. So obviously they kind of killed it on 2020 buying the dip. We're up decently, but then since early 21, it's just been downhill as these things are all topped out, to the point where now they're estimating that they've made no money, basically, right? Those retail flows. So that suggests that, you know, maybe the firepower there to buy the market is kind of dissipating. If these guys don't really have stimulus checks coming through the door to give them more firepower, and they're not up any money, you know, maybe they're not really going to be on the bid anymore. They might even need to kind of start liquidating and stopping out if they've got any money left, right? So that's, and especially with inflation biting and things like that, you kind of need money to pay your other more essential bills rather than your trading book, basically. So that's the idea. And then apparently, you know, retail did sell about $2.2 billion yesterday, which is the 5th biggest sell day since 2016. So starting to see retail basically getting flushed out. The S&P chart, just sort of look at levels. What do we got here? So, you know, that pop we saw post-Fed got capped out by basically this resistance that had been a pretty formidable resistance the week before. Right, so we had this really sharp acceleration post-Fed there from 41, let's say 4150 up to 4300. Couldn't manage to stay there very long, and you know, by the next morning we'd started selling off, and once the US got in, it was like it was curtains basically, right? So gave it all back, and then we accelerated through, and then that big 4050 level was kind of breached, you know, yesterday. So that's kind of the price action we saw in S&P, pretty much mirrored with everything else. NASDAQ getting hit even harder, Russell kind of friendless as well. You know, so all those charts looking pretty ugly. As I said, you know, on the week on week, it was kind of it was smalls down because we'd already had, you know, a previously bad week, but Europe and China still under pressure there, significantly down. Yeah. Now the big level here is 4,000. You know, according to Spot Gamma, that's where we got the big open interest. Whilst, you know, the market is in short gamma mode, has been for some time, you know, the fact that we're not accelerating through here and the fact that VIX isn't really catching a bid are quite telling, basically, right? So I would argue that whilst the model suggests that, yeah, we're in max short gamma territory, you know, the markets are choppy, things like that, the fact that the VIX isn't catching a bid is also telling you that dealers aren't quite as stressed out as you might think if they were in max short gamma territory, right? So the fact that we've got, you know, market accelerating lower on the S&P, VIX not really keeping pace with it on a relative basis, right? If you look at last couple of months, you look at this chart on the right, this is basically kind of plotting the different sort of colored dots are the different maturities. And whilst we have got an inverted curve, so you got the purple at the top, you know, the levels of the vol are kind of still, you know, holding in there, right? They're not really breaking out. So that suggests to me that maybe some of the protection buying that clients have done has been the type of stuff I've been buying, right? Like put spreads. And when that happens, obviously, initially, yes, the dealer is short a bit of Vega, but as you break through and the put spread goes in the money and you move towards the lower strike of the put spread, dealers actually get longer vol, and they don't need to chase the vol anymore, basically, right? Because they're getting closer to their long strikes. So the client's kind of sitting there happily, longer put spread for protection. It's ticking away. It's making its money. It's offering the protection that they require, and dealers are getting, you know, longer vol on the way down, and they don't need to chase the vol higher. For me, that's what it feels like here, where, you know, you get this sell-off and vol doesn't really react. Basically, it suggests to me that dealers have probably been you know, selling put spreads to clients. Now there will be an area, and whether it's 4,000, whether it's a bit lower down, there will be an area that if we break lower and we move away from those strikes of those put spreads, then dealers are short again, and we do get a real explosion in vol. right? Now, Spot Gamma have been just suggesting that might be, you know, if we break 4,000, remains to be seen. Yeah, I suspect breaking 3950, 3900, VIX is going to be above 40 basically, right? I'd be pretty surprised if it wasn't, right? So those are the kind of things we need to be looking out for. You know, looking at the flows, looking at the hero, that they're not suggesting there's a mad panic basically, right? You know, we opened down and we out of the gates pretty much saw monetization of puts and buying of calls. Now, late in the day, you know, this hero indicator is suggesting that some of those calls that were bought were smashed back out into the close. So it may well be people are buying calls as a, you know, short-term trading opportunity with a view to not holding on to them for very long. So that might have been where you got that call selling flow come from. But in general, even last week, as markets were making lows, we're typically seeing put selling, right? So that suggests that people aren't really panicking, or they've had plenty of time to de-risk, take off their equity exposure, and are happy to monetize puts basically. Yeah, dollar's been breaking higher for a bit now, hit that key level at 104 on the DXY, kind of stabilized there. We saw that little dip to sort of 102.5 post FOMC, but my God, that got bought back quickly, similar to risk assets rolling over, right? So dollar momentum, as I'd flagged last week, dollar was picking up momentum as it was breaking higher. And so it's hard to call a top. Now, the fact that it's pulled back and then retested those highs, arguably there's some more fragility there that the dollar could reverse, right? Because some of that momentum has been taken away through that correction. So keep an eye on it. Like I say, fundamentals are still strong there. And I don't really like what euro and dollar yen have been doing, but you know, it's as a contrarian trade, yeah, maybe the dollar's a bit toppy here, right? So if you have been long, like I said to you guys, I've taken some profit on my dollar calls that I've had. I've still got them because they're 6-month options. And for me, I just see them as kind of global risk asset hedges, portfolio hedges more than anything else. And now I've got them on for free. So I'm happy to ride them. But it's one of those things, if the dollar really does start to break down and goes back below 102, then maybe it's one of those things where, okay, you take the money and run basically whatever money you've got left on those, right? So that I'll make that decision when it comes. Yeah. But that's kind of what I'm seeing in the dollar. You know, strong price action in general, whilst other assets are getting liquidated. Obviously, CNH has been slipping. That's kind of helped as well. You see this big move in US versus China rates. CNH kind of moving up in sympathy with that now that they're letting it go a bit. And also with what happened with dollar yen, we talked about, you know, how China's competitiveness, they're going to need to let that devalue. So we're definitely seeing that. And then in general, sort of economic weakness in China, given the lockdowns and stuff, right? So that's also playing its part. Overall, on the week, what have we got in commodities? I mean, nat gas has been pretty spectacular, right? It was up best part of 20%, and it's now down 5% basically, right, on the week. So pretty crazy reversal there in nat gas. The only one really hanging on for dear life, still positive, is wheat, and then everything else kind of down. I mean, gold small down, you know, not really getting that killed, but, you know, crude down 2%, corn down, silver down quite hard, uranium down 5%, palladium down 6%, and aluminium down 7%, right? So all the base metals kind of getting hit to a decent extent. Copper down a couple of percent as well there, right? So obviously that story's been about China. Chinese demand obviously being impacted, metals kind of being the worst hit on that story. Ags and energy kind of were holding up better, but even those are starting to give way basically. Now that's partly because the data on Chinese imports is showing quite a major reduction in imports in natural gas, in coal and things like that. So that's definitely weighing on the commodity sector. We also saw speculative longs getting cut. We've seen that as a theme, but that continues. So you've got here's some data here on across the different energy, metals, and agriculture. So you're seeing a downtick there in managed money positioning. I do think there's still quite a bit of space for the agricultural one to come down. I mean, you look at where that is in its, you know, going back 8 odd years, it still looks pretty stretched. Whereas, you know, energy and metals, not so much. So I think that is the risk factor. So this is kind of the charts out from Saxo on kind of the planting conditions and planting progress across the different crops, basically, right? So you see winter wheat miles below average, 5-year averages, and kind of not really going anywhere. Spring wheat kind of going up, but kind of still miles below averages. There's your corn, there's your soybeans. So all of these crops really being impacted. And we're seeing that obviously in the price action, the recent price action of these things, right? So the fact that the recent price action of the last 2 weeks, these things will come off, even though the planting season is going so poorly, suggests that a lot of that's in the price now, basically, right? So, and then if you look at the managed money positioning, yeah, it's come off the highs, but it's still, you know, at the top end of the 5-year range, basically, right? So I think if there's more pain to come in commodities, there's certainly some pain to come here in the ags, where there's probably still a fair amount of spec positioning being parked. And if, you know, we know markets love to find pain points, I would suggest there's still more pain to come here. So me personally, I'm out of any tactical longs in wheat. I got stopped out a week or two ago. I'm not really looking to add. Like I say, I think there's definitely risk of a liquidation here. I think equities is at risk. I also think commodities is at risk of some kind of broad liquidation type moves where everything sells off together, basically, right? And the last thing as well is, you know, commodities have been the one place to hide this year, right? Stocks and bonds have got completely annihilated. Commodities, if you've had commodities in your portfolio, you've done all right. So the question is now, is that going to be a pocket of pain in the short term? Because that's where people have been kind of camping out, right? And given China, given the China imports are falling, iron ore, crude oil, nat gas, coal, they're all falling, and they're doubling down on their zero COVID policy. You know, I definitely think there's a risk there in commodities across the whole spectrum. So it's something to be very careful on. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.